Hi there. Happy new financial year to everyone. There's a bit going on in small business world and around the economy. At the moment, mainly to do with pricing. And today I just wanted to provide a few tips and a few observations that I've been having with clients in relation to maintaining your margin. So gross profit margin is one of the keys to operating a great business, in my view. Not rocket science in that statement, but the practicalities of maintaining in the current environment are quite challenging. And so gross profit margin, what does that look like? So it is pretty much your sales less your cost of sales in simplistic terms. For each business, that cost of sales looks a little bit different. So if we take, say, a builder, then your cost of sales will include the materials you used on the job, subcontractors you've used, and labour for yourself. So maintaining your margin in the current environment for builders with the price of materials is extremely challenging. They've sort of been up in that space for a little while now, when I say a little while, a few months if you want. Whereas the rest of the business community is probably being challenged more recently with the price of or cost of labour. So salaries and wages for most businesses are quite a significant part of their expenses. And the Fair Work case, which came out 2 weeks ago now, I think, which looks at the minimum award payments. So their announcement was that the first pay period in July, a 5.2% increase for employees on a minimum award, and a 4.6% increase for anyone else under award conditions, as in they're paid by an award level and not an agreed rate or above award payment. There are some exceptions for some industries. I think retail and hospitality doesn't kick into October, but the majority will kick in July. In addition to that, we've got a 0.5% superannuation guarantee increase from the 1st of July as well. So that goes from 10% to 10.5% and is legislated to increase by 0.5% per annum over the next 4 years. No, longer than that. We end up at 12% anyway. So that's the challenge now, is to just rework your pricing. And this excludes some volatility and just dramatic price rises in the oil prices, as we see in the petrol prices, which has had a flow-on effect to food prices and supply chain issues. What else? We've had shocks in the power industry. I think locally here it's 10.5% average price rise coming our way, and other price rises. I think the local councils here just announced their rate rises, and it ranges between 3.5% and 10.5%. So we're living in a quite a challenging time with inflation. So if we focus on the salary and wage component, then what do you do? So in average terms, if you took 4.6% is your award increases. So some employers are going, well, I'll pay above award. The pushback I'm saying is that if an employee doesn't want to go backwards, so relativities, they're probably, a conversation at some point, if not mandatory, that they're after sort of some form of pay rise to keep pace with inflation, which running around the 7% mark currently. So how do you price that accordingly? So some rules of thumb. These are rules of thumb. So these are guides. I suppose the two messages from today are to be vigilant and to take action, not just being vigilant and watching. I think that now's the time to take action. Work through what your price points will need to be, and then I say build a bridge to get there. You don't want to be, say, like a Qantas. I was sort of on Webjet the other day to work out a price between here in Melbourne for a flight that normally costs you maybe $100, $140, something like that. And they were charging $900 to $1,000 for a one-way fare, which, obviously they don't want people to fly. So, you've got to build a bridge. You still want to maintain your customer base, but you want to basically got to build a bridge and a pathway for clients and customers to pay more for those services. So some rules of thumb. So if you are in a materials and labour component, such as the building industry, they should be aiming to get at least a 40% gross profit margin and maintain that going forward. That's on your labour, and then aim for a 20% markup on your materials. Some people push back on that because they can get the materials elsewhere. Historically, it's been 10%. My view, it needs to be at the 20% margin to make up for all the times that there's lots of little losses of time in terms of ordering and waiting for delays and following up orders these days. So it's not a streamlined process anymore. So 40% gross profit on your labour costs. So just remember, your labour costs are not just the wages you pay, so it's the gross wages plus your on costs. So your on costs, the definite ones, the direct on costs, the superannuation, that's mandatory under the government policy, 10.5% of wages. Pretty much normal ordinary time earnings, which is the definition, is most people's gross wages these days. There's a few exceptions to that rule, but for your costing purposes, you can rely on 10.5%. Then you have got workers' comp, and in Tasmania, it's a percentage of wages is normally your policy. That could be 1% up to 10%. I think someone was quoted 12% the other day, which they can go ahead with, but yeah, can be quite expensive. So that's factored in. That's a direct cost of employing. Then you've got different ways. Some people call it a recovery rate or a productive time. So in a full-time employee, 38 hours a week, 52 weeks a year, 1,976 hours a year is the total amount of time, but that person's not available there because, we then deduct your 11 days personal leave, your 20 days annual leave, public holidays, depending which state you're in, around 11 or 12 days. So you got those deductions already that people are entitled to if they're a full-time employee. So your 1,976 hours comes back to around about 1,500 hours or thereabouts. And then not every hour that someone's at work is that they're productive. So if they're a builder, more likely that they're on the job, but then you might have an apprentice who's at TAFE. So you have to deduct those hours. They're not available for whatever the TAFE blocks are throughout the year. If you are, say, a workshop scenario, mechanical, welding or something like that, then there are some hours that are just going to be deducted for team meetings, toolbox meetings, safety meetings, stuff like that you just know that you might only get, say, 80%, 85% of person's available hours after you've deducted all the leave entitlements that people have. So then you work out, okay, what is that person's available hour or number of hours available per week or per year, and then you work out how many, what your cost base is for that, to then come up with what that person's hourly rate will need to be. So some rules of thumb there. So in professional services side of things, you've got 3 to 4 times someone's pay rate. So if he's paying someone, say, $25 an hour, you need to be charging them out between $75 and $100 an hour to maintain your margin. The aim is to try and get closer to 4. The reality will be that things always don't go to plan. You might be at 3. So the 40% gross profit margin that I gave in the building industry as an example, that's calculating all those costs. And in the building game, you've also got long service leave, compulsory long service leave payments as well. So at the end of the day, so if you're paying someone $1, but you're left with, you pay them, so for the $, that you earn, you're paying them and all the other associated costs 60 cents in that $1 that they earn for you. And therefore for you, you've got 40% of that at the end of the day. So lots of maths involved, different ways of looking at it, but I suppose the encouragement there is to really focus on what you need to do in terms of increasing your prices. That's the reality of the world we're living in. And I haven't even touched upon what do you do to factor in associated costs with, power, rents, insurances going up. So you've got a whole range of other factors in there. So I suppose the simple approach is that you've at least got a 5.1% increase across in your labour charges to factor in my view. So it's 4.6 award rate increase plus your superannuation guarantee of 0.5%. So, if you say, okay, we need to increase our prices by 5.1%, how do you do that? Just work through your communication methods, and then you may build, as I say, build a bridge of how you might get that, and some other ways of improving your profit margin. So there might be, so in the materials, you might set some minimum measurements. So if someone buys it as in the actual lengths at the moment, you might say it's a minimum 2 metre length to buy that particular product and stuff like that. So there's a bit of extra margin you can gain in some of the materials. So I suppose just don't be bashful in trying to improve your margin, because your margin is going to be automatically squeezed over the next 12 or 18 months in terms of this whole inflationary environment. No one's really sure where it's going to be, just to deal with the knowns, but it's better to start this process rather than saying, I don't know where to start, just start now. And the last thing you want to do is get 18 months or 12 months down the track, or 6 months down the track, and say, I wish I'd started the process and at least done some form of price rising as we go. Customers hate surprises, so it means, updating your terms and conditions, your quoting, your estimates, so that people are not having false expectations. The other one is, if you're in the opportunity to do job quoting, then ordinarily I say go for it. In the current environment, I'm going, maybe not. Higher risk environment, the higher risk, higher reward. Often you can load some extra additional factors and you move away from hourly rates, and that's ideal to try and move away from having discussion, was the plumber there for 15 minutes or 20 minutes, that you say, no, I'm on site, it's a minimum $250 to be on site. That's just our rules going forward. So there's a job rate. Just be careful, as we're reading in the media and even locally, that those long-term fixed price quoting, you've got to really build up some breakpoints into that fixed price quoting, because pricing is changing quite rapidly and quite volatile on some of the material costs. So you just need to bear that in mind, that you're not locking yourself in and seeing some of the builders have locked themselves into a fixed price quote, having difficulty to amend that, and essentially walk away from contracts, or the whole company going under. So just be careful about that. But ordinarily, to provide a job quote rather than an hourly do and charge will give you a better margin, but bear in mind, just watch that you're not backing yourself into a corner and not being able to recover any price shocks you have on that job. So obviously if the lead time's shorter, if the job's shorter, job's smaller, then you can get away with it. If your lead time's 6 months and it takes you 6 months to do that job, that build, whatever, your risk is much higher. So just factor that in. Just touch quickly on fuel surcharges as well. A few clients I'm working with, fuel surcharge. So what we've done there, we've benchmarked, I suppose, we used January as a start of this volatile oil price movement, and said, what would the average fuel price be there? And then basically using the average terminal gate price out of Hobart as a way of benchmarking and come up with what fuel price net increase has been, and then worked out what that vehicle or piece of equipment uses per hour and come up with a fuel surcharge per hour. So certainly fuel surcharges are doing the rounds as well. So my takeaway is that we have got some definite price increases on your cost side of it. really, really important to keep your margin and not let that margin be eroded. And it can chip away over time, and you sort of, not a nice conversation to have with your clients, or yeah, it's just, you just want to be sort of offering a fair price for fair service or good that you're providing. There's a lot more risk we've got at the moment, a lot more pricing going up. We have got some definites in our wage increases, the 4.6 and the 0.5 for super, 5.2 minimum award wages going up. So I've got some definites. So yeah, just really be really comfortable with your model, what you need to increase your prices by, have the clear conversation with clients. Even if you build a bridge, and it might happen over, a staged approach sometimes as well. You can just sort of lessen the impact, but just start movement and getting your prices, and you just got to have to move there. Otherwise, your business is going to stagnate and go backwards. And a few people have said to me they're busy but not making as much money at the moment. So you don't want to be in that place. If there's enough stresses going on in your life, you don't want to have another stress of trying to pay the bills and having your profit margin eroded. So just really encourage you to start on this journey if you haven't started already, and putting prices up and having those communications with clients. So thanks for tuning in. I'll probably do another update next week after the Reserve Bank's made their interest rate announcement, and just sort of provide a bit more of a macro economic sort of perspective, what I'm seeing in small business world. So thanks for tuning in. Hope it's been useful about trying to maintain your profit margins in the current environment. See you later.